Hello and welcome to The Real Economy with a focus on the middle market and the economic headwinds facing it. I'm Gigi Stone-Woods, your moderator for today. We're going to be taking a closer look at the big questions around the recovering economy. And we have the two very best people to explain it all. Joe Brusuelas, Chief Economist of RSM, and Neil Bradley of the U.S. Chamber of Commerce. Joe and Neil of The Joe and Neil Show. Thank you for joining us today. A lot of upside to discuss with the economy. Inflation coming down, employment is strong. What is the state of the U.S. economy right now?
It's got a nice brisk tailwind behind it. It looks like in the first quarter of the year, we're going to come in with growth somewhere between 2.5% and 3%. It looks to me as if we now are going to enter the 27th consecutive month of unemployment below 4%. Inflation growth is easing back to a place where I consider tolerable. It's 2.5% a year on the metric the Fed uses to make policy decisions. So there's a lot right going on with the U.S. economy now. And I think one of the big takeaways for everybody out there is the U.S. economy is just outperforming all of its global peers. And I don't mean just beating it by a couple of inches. It's outperforming by a country mile. So things are going to be very solid this year.
Of course, Joe's exactly right. It's not just that we're outpacing our peers, though. In many respects, we're outpacing a lot of the observers. I want to give a lot of credit to Joe and the team at RSM. If you think back a year and a half ago, people who weren't looking at what was really happening in the real economy, what was going on the ground with these mid-market firms and their employment, where they were with demand, what they were doing with respect to CapEx, were telling a story of a future that's very different than the one that we're living right now.
100%. Kudos to you, because you got it right.
It turns out if you pay attention to what's really happening on the ground, as you do, then it's a lot easier to have a sense of where we are and where we're going.
Listening to those small business executives, listening to industrial manufacturers.
That's right.
Yeah, keep your ears to the ground. All right, let's talk about rising oil prices. That seems to be in the headlines right now. How could that affect things?
Well, certainly if the price of oil were to skyrocket, back towards $110 to $120 a barrel, that would slow down both the American and the global economy. But with prices between $80 and $90, I just don't think that that's really much of a headwind. Now, I know for consumers and households that are sensitive to the price shock that everyone had to endure over the past couple of years, that may cause a little bit of consternation, especially down market. But my sense is, while people are not happy about the price level, it's not getting in the way of their actual behavior. They're out spending. I'm expecting a very strong, brisk summer. People are going to get out there and get on the road and go on vacation, even if the price of gasoline is at or above $4 a gallon. They won't like it, but they'll pay it.
Speaking of summer, what about June? That is one of the possible times when we could have an interest rate cut, and that is to be the big question. June, fall, how many cuts are we going to see? What are we expecting?
Well, so our forecast is that we get the first cut in June and that we get 3 this year. So we thought 4 at the beginning of the year when we laid out our forecast, but we think that's inappropriate now because of the strength in the economy. Now, what's interesting is that as we move back to this era where there's a cost for the price of money, money is no longer free, right? You should expect higher for longer, higher interest rates. We're going to have higher inflation than we've had for the previous 20 years. And we're bringing back things that we used to use. And I prefer a rules-based framework from policy that's augmented by judgment. My judgment is that the unemployment rate, the full employment is around 3.6%. If I plug that into my model, it tells me that the interest rate should be around 4.4. That's 3 cuts from where we are now, between 5.25 and 5.5. The rate is restrictive. What it means is we can cut rates as inflation comes down, and we can have much stronger growth and sustain that low unemployment without running inflation risk. And this is, I think, the initial stage of a very optimistic outlook for the post-pandemic economy.
There are a few dissenting opinions.
Yes. But in many ways, a normalization. We kind of got used to free money for far too long. and then we got hit with a shock of inflation that most people in their professional careers had never really had to navigate, particularly in senior leadership. So you're going back 30 or 40 years the last time someone had to navigate and run a business with this level of inflation. And so it feels odd to people in some ways because it's not what they've known or experienced, for maybe the past 10 or 20 years, but it's not inconsistent with a growing, steady economy where money is not free and you have moderate inflation.
So what are your businesses telling you? Businesses seem optimistic, and yet individuals are still sour on the economy.
Well, we are still in the height of secondhand pessimism, and we can play armchair psychologist about what is driving that. I mean, some of it is kind of the politicalization and polarization in everything in American society today that tends to taint people's lenses. Some of it's the news that we consume. If you watch most newscasts today, I don't care on what side of the spectrum on the cable TV you're on, you tend to hear pretty negative stories about the economy and the basic economic inputs. You don't tend to hear the good news. The interesting thing is that people make that adjustment for how they think about the economy writ large, but they know the economy that they experience, and that's where you end up with this distinction that I may think the economy writ large must be bad, but the economy in my community or in my industry or for my business is actually quite strong. And it can't be the case that everyone's local and industry and business are strong and the overall economy is bad. Like that, those two things don't matter.
Our friends over at the Business Roundtable released a very good survey about CEO confidence over the past 6 weeks. It had one of the biggest jumps in decades, right? And inside our own RSM Middle Market Business Index, for the past 14 quarters, we've seen a strong plurality actually increase outlays on productivity enhancing capital expenditures, and a strong majority have said that they intend to do so during that same period. So essentially, the shock of the pandemic caused a change in behavior in the corporate sector that we now can look back at. It started really around June 2020. And that's why we have this 2.5% productivity on a year-over-year basis, which, we all got used to that 1.3% increase over the past 20 years. No, something's happening here, and it's good. And so what I tell people when I go out on the road and I talk about the economy, don't watch what people say. Watch what it is they do, especially mid-size and large corporates, because that will give you a much better idea of where the economy is going than if you're looking at a consumer sentiment survey that, like Neil says, is going to tell you, well, things are really good in my house, in my neighborhood, but they're bad everywhere else. No, that's internally inconsistent and just simply not the case.
What about this employment rate?
Okay.
Can we keep this up?
Yeah. Yes, we can. We can, look, we just don't have enough workers. Yeah. We had the jobs opening layoffs turnover survey. Okay, for all you at home, that's something only gearheads like myself pay attention to. But what it told us was we have 1.4 jobs available for every individual that's looking. We've had times in the past where this has happened, but not for a sustained period of time. This is something new that I just haven't observed in my entire career arc, right? And I got a 5 handle in front of my age these days. So this is something that's new, it's novel. We're gonna have to make policy around it. And what it means is that we can grow faster. We can have a lower unemployment rate. And if we're making those capital investments in productivity enhancing equipment, software, and intellectual property, that means we don't have to run the risk of inflation either. It's approximating the conditions we saw in the late 1990s when the Federal Reserve correctly identified that there had been a pivot upwards in productivity and dialed back the rate increases and indeed ended up cutting them. And we had a pretty good decade-long boom in productivity.
The folks who say that the labor market's going to normalize,
yeah.
Normalize to what? What is your definition of normal? And to pick up on Joe's point about the differentiation between the number of people looking for jobs and the number of job openings. Historically, on average, it's always been the case that we have more job openings than we have people looking for work. Now, what you began to see, particularly with the retirement of the baby boom generation, smaller cohorts coming behind in the workforce, is even right before the pandemic, we'd entered a period where month over month we had sustained instances of more job openings than people looking for work. That quickly reversed itself in the very early months of the pandemic when all of us were shut down, didn't know what to do, and then completely flipped. And so the new normal may be that we have more people, more open jobs than we have people looking for work as a result of our current demographic makeup, the changes that we're going through, which means that the productivity enhancements become all that more important. And so it really does create lots of opportunities for the American future economy. We get to have an economy with low unemployment, plentiful jobs, and higher economic growth because we're making the investments in AI and automation that allow us to help meet demand in that tight labor market.
And I know it's controversial, but immigration, we have
has to be part of it.
Yeah,
Okay.
it's part of it.
You know what? The labor force has grown by about 2 million people because of immigration. We wouldn't have the growth or the productivity without it. One of my favorite economists, Ernie Tedeschi over at Brookings, published a piece yesterday which made a very persuasive case that the ability of the American economy to absorb the immigration has resulted in a boom. I mean, it's just is a fact at this point. I know there's going to be lots of people unhappy with that, but it's what's occurring. And to be honest with you, we needed it.
That's right.
We really just do. We can't do without it at this point.
Let's talk about the upcoming presidential election.
Are we having a presidential election? Is that this year?
No.
A few economic, I know you're very actively involved. What are some of the economic risks around it?
Well, I think that if it looks as if we're going to have a contested election, there may be a pullback in some of that virtuous investment in productivity enhancing software equipment and intellectual property. To me, that's the major risk economically. But, and I want to say this is really important, we went back and looked at our survey. You know, other than very small firms who are more worried about the regulatory outlook, you just don't see a change in behavior as you approach the election. So really, it's more noise than signal around the election. The economy is going to do just fine this year, as long as we don't have another contested outcome, I would think.
And if you think about the macro things that we've talked about so far, right? So the worker shortage, the investments in productivity through artificial intelligence and other means. These are macro trends that are governing no matter what happens in our election process, right? These needs to make these investments are going to continue to occur no matter who's up or who's down in the presidential polls. Now, when you get into individual industry sectors, there are some significant policy differences between the two parties and between the two prospective administrations that could have impact in different industrial sectors. And so the direction that we're going in energy policy or in fuel economy standards, for example, could have some impact there. You're going to have
a lot of regulations that are coming up that it could affect those industries.
You're going to have because of some weird, quirky rules in Washington about when regulations should go final in order that they may be sustained from one administration into a next. You're going to see lots of regulatory activity between now and our estimate is the end of June. And so you're going to have lots of final proposals coming out of the administration. And you're going to have lots of, in different industry sectors that are impacted, that questions about whether that's really going to survive either legal challenges or survive into the next presidential administration, should there be a change. And so there'll be a lot of people looking at that. That said, you also have some real challenges once we get past the election. And so when you think about the things that the next Congress will have to do, the debt limit, which we've talked about before, we have a massive, calling it a tax cliff is a disservice to cliffs.
The Super Bowl of taxes in 2025.
You know, that are things that people are going to be looking to the elections for kind of tea leaves as to the parameters of how these issues are going to be resolved.
I feel like neither candidate, or I know there are more than two, are talking about how they're going to pay off the debt, spiraling healthcare costs. I feel like these issues haven't really been at the forefront of the debates.
Well, I mean, neither are going to pay off the debt. The debt's just going to be with us in terms of thinking about creating the conditions where growth in government spending could be sustainable. What we want to focus on is sort of what we call the primary budget deficit, the deficit X interest that we owe on past spending. If we can balance that and we continue with this 2+% growth, we'll be in good shape. But that will take some work on the part of Congress and the next administration to put us out on that course. Now, with respect to healthcare, you know, the most amazing things happened in healthcare. The cost curve was actually bent. It's actually flat as a percentage of GDP going back now over a decade. There's some good things that have happened in policy land with healthcare. Now, when you talk to people on the ground, of course, they're going to be upset because sometimes in some areas there's lack of availability. If you live in Phoenix, it's difficult to find a doctor or a nurse right now. There's just not enough supply. I live in Austin, Texas. We have a very similar condition. It's very, very difficult to find somebody, right? So you're going to have wide variation. But my sense is that healthcare actually, as a percentage of GDP, is stuck right around 17.2, 17.3%. That's a substantial policy achievement that people should be quite proud of.
And in fairness, that we're not exactly sure how we achieved.
That's
like
right.
It kind of surprised the independent experts. And one of the reasons it's so critically important to maintain that type of level is we're talking about achieving it with a generally older population. Right, so you know the big fear has always been if you can't get healthcare costs under control at the height of the baby boom retirement, where they're consuming the most healthcare,
right, then
you could have a real problem. This goes to the magic of kind of the free market in many ways, right? It wasn't great central planning that did it. We've figured out new ways of efficiencies in the healthcare system that have allowed costs to generally stabilize. I actually think there's an opportunity, largely based off the innovation and the investment that's going on, to actually bend it down further. And so when you think about the benefits of artificial intelligence, for example.
Yeah, that's having tremendous implications for healthcare.
Tremendous implications. And you're thinking about a shortage of radiologists looking at radiological scans and how much of this can be first tranche through AI. There's so much work that can be done there that can really help us manage these future costs.
Wonder drugs like Ozempic, which are going to clearly change the health care of a major part of the population as it ages. And again, as we integrate artificial intelligence into everything, we're going to yield productivity gains in very different ways. You know, our clients in the middle market aren't quite there yet. But on a board I serve on where we have large corporations, they're starting to reap the benefits from AI. And it's not showing up in the statistics, but they can see it in their bottom lines. Now that's exciting.
I'm so glad I asked all this
things
optimism.
Are gonna get better. No, things are going to get better.
What about concerns about AI on the workforce?
Okay, so if we go ahead and develop artificial intelligence with just the idea that we're going to replace existing workers, you're going to have that outcome, right? But that's not how this has to be. It's just not the case. We can go ahead and we can create a framework where AI is allowed to flourish, but it's done in such a way that it's going to create opportunities, not just replacement, right? Now, it's going to be a very delicate balance there, and we're going to need to have the public and private sector cooperate around this. But it's not just a one-way mission whereby we get rid of everybody who works in the administrative sector between 25 and 54 who have less than 2 years of college. Well, no, just that doesn't have to happen, right? And I don't think it will.
No, those are the alarm bells are sounding, yeah.
We should not listen to those alarm bells. We've been through these. It's not artificial intelligence, but the personal computing revolution, the internet revolution, industrial revolution kind of before that. Markets have a way of figuring out in ways that no government can ever do or plan how we're going to create new opportunities and new industries and new jobs that people will acquire the skills to fill. And so if I have a concern, my biggest concern is that policymakers will act out of a fear and try to hamstring artificial intelligence in a way that produces the worst of both worlds. And the worst of both worlds is that you don't get the fullest positive benefits of the productivity boom that AI can give you, and instead you get some lower level of the productivity enhancement. But that productivity enhancement is enough that it does dislocate some jobs, but what we gave up on the productivity enhancement was the things that were going to create the new jobs. And so the risk here is that government tries to manage this rather than recognizing that the market is going to do this a lot better and that we can triage as we go whether we need more on skills training in midlife, whether we need to rethink about how we provide Pell Grants, for example, for people who are caught on the outswing.
The technology will outpace the government every step of the way.
Every time.
Let me give you an example. Just 6 years ago, there was a boom in cloud computing and a demand for cloud engineers. And I remember at the time, I could see them literally, right, the demand for it. People I knew were taking these jobs. But when you went into the Bureau of Labor Statistics, they didn't have a NAICS code for cloud computing, for cloud engineers. It was like it didn't even exist, right? But it did, and it was very much part of the migration in terms of how we store and how we utilize data, right? So the market's always going to outpace the ability of the public sector to keep up and actually regulate that. And in this case, it's probably a good thing because we'll create scalable industries that don't yet quite exist because they're just beyond the imagination of people who are working in other industries. And that's why this economy will always end up outperforming its peers over the medium to long term.
Great segue, because we are talking about it outperforming its peers. Yeah. We have to talk about China. China used to be this unstoppable juggernaut. Now we're talking about it, or some are talking about it being uninvestable, talking about China's debt in the headlines. What is going on with China? It exhausted its resources during the pandemic. What does the future hold?
Well, like Japan in the 1990s and the United States in 2007, it has entered a debt and deleveraging period driven by an overhang in the property sector. In this case, there's too much investment in residential real estate, commercial real estate, and effectively it's brought to an end the 30-year business model of the People's Republic of China, who has directed capital, scarce capital, into housing, commercial real estate, and manufacturing. And it's now to a point where they can't disseminate data, whether it's on the unemployment or the employment situation or even housing prices. I've got a good friend out at UCLA who really is an expert on the Chinese economy, and he's told me that, well, it shows that they've had a 5% decline in property prices. Well, that's not the case. Really, it's more like 50 to 70%.
Wow.
And in some cases, it looks just like what happened around Phoenix, Arizona, or Nevada, Las Vegas.
We've been through this.
Yeah, you can see it. And when an economy enters a period of debt and deleveraging, it takes 7 to 10 years to work through. And my sense is that when China gets through this, that unstoppable juggernaut is going to be just another economy. An impressive one with scale, but not the one that it was made out to be. Moreover, they're making huge mistakes with respect to re-centralizing power of the Communist Party over the ability of entrepreneurs to engage in dynamic ways that expand the market. They're clearly worried about social instability, and they're trying to reimpose control. And that's one of the reasons why foreign direct investment, which for decades was just a one-way street, has turned around and left. Money's flowing out of China, and they're going to be they're going to have a challenging decade ahead of them.
Neil, there's a lot going on in terms of China and Washington with this potential ban on TikTok and potential ban on Chinese electric vehicles. Talk to us about how this is all happening.
Yeah, let's start first with the economy in that aspect of it. So, this has always been a tension between growth and security. for the Chinese. And so both internal security and their security from what they perceive as their adversaries around the world. And I think we may have entered a new period where the balance is much more on the security side for the Chinese than it is on the growth side, and there may be some sacrifice to growth. That's going to create some initial distortions, and maybe even too polite of a word for it, in the near term as they try to balance out how do they sustain some level of growth with that security. That means taking advantage of their overcapacity. They make more things than they can supply in their domestic market. They're making more things than they can supply in the international market. And so there is a lot of concern that they'll try to export a lot of their economic problems to the US and to Europe by basically flooding the export zones, including in cars. And this is some sense of what you're getting there. I think from a policymaking in Washington standpoint, policymakers have got to become really precise. They got to be precise about the things that constitute real national security threats to the United States, and those require discrete actions to deal with. And so when you look at some of the export controls, the licensing regimes around technology, some of what we're doing with respect to chips and those things, you do want to see concrete actions discretely tied to precise national security threats. Then you're going to have a second issue of this overcapacity and this dumping. And we do have remedies that we ought to avail ourselves of if there is actual dumping into the market below production costs, and we ought to treat that the way we would treat it any other time that we've seen it. The reason that becomes important is because there remains a really important third sector. And that third sector are things that aren't national security concerns, that aren't a question of dumping or economic manipulation, but that are really important for U.S. companies in growth, right? Our ability, whether we're selling soybeans or other agricultural products into China, whether we're selling coffee or movies, whether there's production that is not of national security concern that benefits the U.S. global supply chain or helps supply to the region, leaving that intact and not conflating it with the national security or the overcapacity issues becomes really important for U.S. policymakers. That's going to be a challenge because that long explanation that I just gave you does not play well in 30-second sound bites on TV, and sometimes
that's why it's so great that we're doing this, so we can have a nuanced, thoughtful conversation.
And we need policymakers who are having those nuanced discussions, not the bumper sticker that kind of treats all things China the exact same way.
Right. Cable news.
Cable news.
I have some good questions from the audience here, so let's see. How do these economic themes impact the CRE market, specifically debt?
Well, the CRE market is actually starting to stir a little bit. We're seeing spreads narrow and refunding start to happen. Now, we think that this is going to be a 2024, 2025 phenomenon. Loosely, there's about $1.5 trillion CRE that's going to have to roll over. There's going to be some haircuts, right? But what we want to see is as interest rates come down, as inflation eases, we can get the sense that the interest rate cuts aren't just going to be 2 or 3. It's going to be a multi-year phenomenon, say between 2024, middle of 2024 through the end of 2026. Then the market will take care of that. And I want to repeat this. The problems in the commercial real estate market are not systemic. They're highly localized and can be addressed within the parameters of American debt and capital markets. It does not need a bailout by the federal government. We know how to do this, and this will work, and we'll be better on the other side because of it.
And I think to add to Joe's excellent point there, I mean, the other thing when we think about, because people immediately go to our banking institutions, so what does that mean? Not all commercial real estate's the same, right? And so you have to differentiate between your exposure in, say, office buildings downtown that have not returned to occupancy versus retail centers or healthcare or multifamily housing. three really strong areas in our economy. And I think we should have some confidence that the balance, that not every institution, to be fair, so not every institution, but a lot of our financial institutions make this something that they have the wherewithal to work their way through, including with haircuts.
But we've talked about this, the office buildings in urban areas, those are some real concerns with leases coming up that we haven't even seen the full impact.
So, if you're a Class A or a Class B building, you're not having a problem, right? It's the Class C where the owners did not invest in the appropriate amenities and infrastructure commensurate with what modern firms need that operate both locally, nationally, and globally. So in many cases, this is just the market sorting itself out in addition to the recognized shock of people working from home now. It looks like we have about 1 out of 5 people work from home sometime during the week, maybe 2 or 3 days. So it's changing the composition of demand in these downtown metros. And then not just the downtown metros, it's the urban and ex-urban metros also, where I think, to be honest with you, that's probably more where the problem is at this point, because you're likely to have the Class C buildings out there more often than not. But again, I just want to reiterate, this is not going to derail the economy, and it's not a systemic problem that requires an unorthodox approach. No bailouts for the CRE market here.
Good point. Thank you for sharing. I have more anonymous questions. No one's being brave today and saying their name. Will rising debt costs require changes to government spending behavior in the coming 10 or 20 years? And if so, how will that impact the U.S.'s growth potential?
All right, so I'll talk about the finance and economics, and Neil can talk about the politics.
Great.
Because to be honest with you, when we're talking debt and deficits, it's more about politics. Each week, Monday through Thursday, we issue debt in the United States, a primary treasury debt market. We don't have any fails. Demand remains strong and well subscribed, both direct and indirect bidders. Second, if we were going to have a problem around debt and deficits, you'd see issues with the dollar. You'd see the level of the dollar being used as currency reserves beginning to decline. And the fact that the dollar's on one side or the other of 90% of all trades in the $6 trillion a day currency market, that would begin to be declining too. None of that's happening, actually. This idea about de-dollarization, as George Will might have said back in the 80s, utter nonsense. It is utter nonsense. The dollar remains the benchmark, the linchpin of the entire global economic system. It really, when you add up the US dollar, the UK currency, the Canadian currency, the European, Australian, and New Zealand currency, you get up to 96% of all currency reserves. Okay, the economics and finance of debt and deficits, we can do this. Now, it doesn't mean we should be spending like a drunken sailor in San Francisco. And we're going to have to make decisions, and priorities need to be made, and trade-offs need to be encountered. But for the immediate, the medium term, we're not going to have a problem financing this. But the politics of this is a very different situation that Neil's more uniquely well suited to address than I am.
I mean, in answer to the question, we do benefit from the fact that we are, as we began this conversation, outpacing every other country in the world in terms of our economy and growth. And so we start from a position of strength. The US dollar starts from a position of strength. Our ability to issue debt starts from a position of strength. There are things that we can do that either add to our strength or weaken our strength. And one of them is not whether or not you run a deficit. And that's where the political debate that goes on in Washington gets really confused. A deficit in and of itself is not problematic if you have the wherewithal to finance it. And if you're not continually running deficits at a faster pace, growing them more quickly, then you're growing the economy. And that's the part that we have to be concerned about. We need to be concerned about the fact that in good economic times, not downturns, not global pandemics, not wars, where it's justified running a deficit bigger than your economy in terms of growth, we're running deficits faster than our economy is growing in good times, and that's the part that we got to focus on. That does mean in the next decade addressing some of the spending issues. It does mean making some changes on the outlay side so that we can get to a sustainable deficit level that supports a sustainable debt level over the long term. So the short answer to the question is, yeah, we're going to have to make some adjustments in spending. These are not catastrophic. We're not cutting Social Security payments by 2/3 overnight. We're not decimating Medicare, the Defense Department, but we need to make modest adjustments in our spending paths. And if we do that, that won't hurt the economy. It will actually strengthen the economy.
And an economy that's growing between 2.5% and 3%, with robust stock market valuations, we're going to throw off all sorts of revenues. The debt is going to shrink as a percentage of overall GDP simply because we're growing well above trend. I mean, sometimes I think that we have all this information at our disposal and we get so focused on talking about risks, we miss the forest for the trees. Things are pretty damn good and they're getting better.
It's making me feel great.
Yeah.
You mentioned the Department of Defense. There's a DOD bill coming up that could really affect defense and aerospace. Maybe tell us a little bit about it.
Well, we finally completed the annual appropriations process. So we funded the government. That was supposed to be done by September 30th of last year. We just finished it a little over a week ago. So, half a year behind schedule is about where we are. It was largely good news for the defense and aerospace sectors. However, we lost a lot of planning and procurement and things that could have occurred in those 6 months. The next thing that Congress has on its plate is what's commonly referred to as the Ukraine, Israel, East Asia kind of supplemental. It's really a security package. There's a lot of misinformation in the public debate that kind of equates this with us, meaning the U.S. government, writing checks and sending money overseas. Something like 85% of this is actually for defense article procurement here in the United States. So we are procuring more defense stocks, arms and munitions here in the United States, which allows us to provide greater military equipment to Ukraine and to Israel. And so this is something that has to get done. I think ultimately at the end of the day, it will get done. That will be important not just for the defense and aerospace industries, but long term in an investment in our capacity domestically to kind of meet our national security needs. And so we kind of went through a period where we neglected our defense industrial base and our ability to produce munitions and defense articles at a rapid pace. This is beginning to help us address that.
Well, I know viewers always want to know about the markets, and while it's constantly changing, the strong economy and all of the good news is almost weighing on the markets because they feel like their interest rates might not be coming.
Well, so yeah, the one of the things that's interesting right now is that the economy is doing so well that we're seeing a sell-off in equity markets and bond yields rising at an interesting pace simply because investors are afraid they won't get their rate cuts later this year. Well, that's just the volatility that you see from time to time across asset markets. Policymakers will tend to look through the volatility and focus on the real economy. And our focus tells us that the current rate of interest that the federal funds is between 5.25, 5.5 is restrictive, and it needs to be brought down. Our own rules-based approach tells us the appropriate rate right now would be around 4.4. That's 75 basis points of rate cuts, 325 basis points of rate cuts, starting in June, every other meeting through the end of the year. We think that'll get us there, and I think the market will respond appropriately. Now, we're in one of these interesting times where private capital is flowing into companies that are in the Microsoft and NVIDIA ecosystems around artificial intelligence. This is a good thing because these companies actually have revenues. They make profits. There's a business use for this. So as a result, we have an overconcentration in asset markets in some of those companies, in those ecosystems. But we're beginning to see that ease a bit. The capital that's flowing in the market is broadening out. And you know, the second week in April, we're going to get the first quarter corporate earnings. You know what? The improvement in productivity equals profits. That productivity increases, margins tend to widen, and things really begin to look better. I'm confident you're going to see that here in the first and second quarter corporate earnings reports for 2024. And then the market will be looking at this in a very different way.
And let's hope that politicians don't look at it the wrong way.
That's right.
And
yeah.
we've gotten into a little bit of a bad habit of late of saying, well, if corporate profits are up and we still don't like the price of eggs, dairy, gasoline, whatever it is, it must be because of some nefarious behavior. At the end of the day, this is supply and demand on one hand, and your investments in productivity and efficiency in the other.
Yes, an efficient market.
Let's not let the politicians steer us wrong on this.
We had a bad case of avian flu in the bird stock. That's what caused the price of eggs to go up. It wasn't the corporations raising prices because they thought they could get away with it. In fact, where I live, I have quite a few choices. It's to the point where if I want to buy organic, free-raised eggs produced by chickens who run wild, well, I can pay $7.25 for a dozen. If I want to just get the local, brand that the market produces, it is about $1.79, and it's my choice, right? So we're caught in one of those very unproductive conversations, because we're beginning to come out of the inflation shock and elections coming, and it's often it's just irresistible for politicians to just talk down the economy and blame corporates, and that's just simply a bad idea.
It's habit.
Yeah.
One of the viewers did ask anonymously, what is driving the large increase in productivity? And we touched on this, but maybe we could talk about it a little further.
Okay, immigration. A larger labor market, a steady stream of investment into productivity-enhancing goods over the past 3 years. And I think the tip of the spear in terms of the integration of very sophisticated technology just into how we provide goods, we produce goods and we provide services. This is incredibly difficult to measure. But for years, our friends out in Silicon Valley have been telling us, you economists are measuring productivity the wrong way. You're missing the boat. Something's happening. And you can see it. I can see the productivity everywhere except in the statistics until recently, right? But what I can do with my iPhone, which is a supercomputer, right, is just stunning. Right? The way I can fly, on Friday night I'm flying to London, right? I'm going to be able to work for most of the time on the plane as if I was at my office. Okay, that didn't exist 7 years ago. You just couldn't do that, right? Yeah, there's something happening here and it's quite good.
And listen, the pandemic disrupted everything. Yeah. In many ways, these disruptions are bad. And there's a lot to look back on and say, gosh, we may have got that wrong. But one of the things that forced was disruption in industries that hadn't been disrupted. And so people figured out, even with existing technology at the time, ways to do things more efficiently, to meet customer demand, particularly in the service side, in ways that they never had before. And it wasn't just people working remotely from home. It was just how services, how goods are delivered, the intermediaries in between. And so we're getting the benefits of all of the things that necessity forced us to create as part of the pandemic.
So last question before we close. Give us some advice for businesses watching for the year ahead.
Be confident, be forward-looking, take the improved revenues and profits and reinvest it in your business. Create a technological framework where your workers can increase productivity to meet that demand, because that demand is going to grow.
I think that's exactly right. If I boil it down, is don't operate out of fear. This is a political year. It's an election year. There are plenty of people selling fear. And if fear forces you to be on the sidelines and to not make those investments, rest assured your competitors are. Someone in your ecosystem is going to make those investments, and they're the ones that are going to come out ahead. So people should be confident, should charge ahead, should not act out of fear.
Okay, sage wisdom as always, great prognostications, and cautious optimism ahead. Neil Bradley of the Chamber of Commerce and Joe Brusuelas, Chief Economist of RSM. Thank you so much for joining us on The Real Economy, and thanks for watching.